Two-way strategy. Make money when the market is up or down. Welcome to Mr. So Crypto, a podcast that will make you more ready to become a smart trader. Here we learn strategies that are not only cool to show off, but also really useful for quant. The crypto market is unique. It's not always pretty, but it's always moving. Sometimes the chart is green like a heavenly garden. Sometimes it's red hot like hell before payday. But the cool thing is, we can stay profitable in both conditions, as long as you understand how, the strategy, and mentally. So if you are often confused about what to do when the market is red, or afraid to miss the train when the market is green, you are in the right place. Let's start with the most important basics. Chapter 1. Two-way strategy. Make money when the market is up and down. Most people enter the crypto world because of a dream. Dream of getting rich quick. Dream of buying a lumbo. Dream of earning dozens of times from small coins. But the reality is, crypto is not just about going up. There are also times when the market drops completely. Like what happened in early 2022 to 2023. BTC had dropped from 69,000 to 16,000. ETH from more than 4,000 dropped to $800. And many retail traders can only stroke their chests because their strategy is only one. Buy when green, panic when red. Alias can only profit when the market goes up, and when the market goes down, shut up, or worse, cut loss in crowds. In fact, the crypto market can be played in two directions, and this strategy is the difference between novice traders and professional traders. The name of the strategy? Two-way, long and short. Long, a traditional strategy that's still relevant. Long is like you buy because you believe the price will go up. For example, you analyze Solana and feel that the project is getting more solid. The market is positive. Institutions are starting to come in. You buy SOL at $140. A few weeks later, it rises to $200. You sell it. Net profit $60 per coin, not including fees and taxes. Yes. This strategy is suitable when the uptrend is clear, market sentiment is strong, and transaction volume is large. But the question is, what if the trend is down? Short, modern strategies to make money in a down market. Now this is the part that is often overlooked. Shorting is like a secret weapon. For example, you see BTC at 70K, but there's a negative sentiment. The Fed announces that it will raise interest rates. Big investors start to withdraw funds. You predict the price will drop. You borrow 1 BTC from the exchange. You sell it right away and get $70,000. 2 days later, BTC drops to 65,000. You buy back 1 BTC. You return it to the exchange, and you pocket $5,000 as profit. Isn't it cool? This is not magic. This is a real mechanism that is legal on many platforms, like Binance Futures, Bybit, or OKX. Why is a two-way strategy mandatory? Because the crypto market is 100% unpredictable, and it's merciless. With a two-way strategy, you can still find opportunities. When the majority of traders are groaning, market in the red, you go short. Green market, low long. Sideway market, take it easy, or look for short-term opportunities in small ranges. The point is this: with a two-way strategy, you can not only survive, but you can grow and make your capital work more optimally. Okay, that was an introduction to the two-way strategy. In the next chapter, we will discuss more technical, how to know when to go long and when to go short, what indicators to use, and how to keep you from being tricked by false signals. Stay tuned, and be ready to become a trader who doesn't just go with the flow, but becomes a direction controller. Chapter 2. When to go long, when to go short. Okay, we already know. The two-way strategy allows us to earn money when the market goes up or down. But the problem is now, how do you know when to go long and when to go short? Well, here we get into the core of the game, namely analysis. Without analysis, the two-way strategy is just like guessing fate, and the end can make the wallet even thinner. So, let's talk about the tools that traders use. Not shamans, but indicators. Part 1. Technical analysis. Read the charts to avoid the Batman trap. First, we discuss technical analysis. This is suitable for those of you who like to look at charts and numbers. But don't worry, it's not as difficult as coding really. There are some simple indicators that you must know. 1. Moving average. This is simply like an average price line. For example, MA50 or MA200. If the price is above this line and continues to rise, That is an uptrend signal. That means you can look for long opportunities. But if the price drops and moves below the MA line, be alert. That's a downtrend signal. Can look for short opportunities. 2. RSI, Relative Strength Index. This tells us whether the price is overpriced or underpriced. A number above 70 means overbought. Too many people are buying. Could be going down. Suitable for shorts. A reading below 30 means oversold. Too many sellers. Could go up. Suitable for longs. 3. MACD. This indicator is to see momentum. If the MACD line crosses above the signal line, it is bullish. If it crosses below, it is bearish. 4. Support and resistance. Support is like a floor. Prices often bounce from there. Resistance is like a roof. Prices are often mental too. If the price breaks strong support, it will usually continue down. Suitable for shorts. If it breaks the resistance, it's a bullish signal. Suitable for long. And finally, volume. Volume is like gasoline. If the price rises but the volume is small, be wary. Maybe it's just a small bounce. But if the volume rises with the price, it is usually stronger and valid. Part 2. Fundamental analysis. Read the news to not be shocked. Technical analysis is about charts. Fundamental analysis is about news and world conditions. For example, you see news that the Fed will raise interest rates. That usually makes the crypto market go down because money is leaving risky assets. Or there is news of tighter regulations in America or the European Union. That can also make investors withdraw money. But on the other hand, if there is good news such as the Bitcoin ETF being approved, or Ethereum successfully upgrading the network, that can be a trigger for prices to rise. The point is, don't just look at the chart, but also be sensitive to the news. In crypto, sentiment can change overnight, and that can be a great opportunity, or a big trap. Part 3. Combine the two. The most ideal. You combine these two types of analysis. For example, chart shows ETH oversold, and you read in the news that a major Ethereum upgrade will be released next week. That's a double signal. You can consider going long. Or, BTC looks tired of going up. RSI is above 70. Volume is down. And then there's negative news from the SEC. That's a good combination for going short. Don't rely on just one side. Combined data plus sentiment equals more solid decisions. Now you have an important provision. You no longer need to guess. With the right indicators and diligent news monitoring, you can be more confident in making decisions, whether long or short. But remember, analysis is not a guarantee of 100% accuracy. So in the next chapter, we will discuss the main weapon that you must have. That is risk management. Because even though your strategy is cool, if the financial management is a mess, the end result is still falling down. Stay tuned and mentally prepare to become a disciplined trader. Chapter 3. Risk Management, the key to survival and growth. If you've listened to the previous 2 chapters, you now understand the importance of a two-way strategy and know how to read signals to go long or short. But it's all pointless if you don't have this one important thing. That is, risk management. Why is it important? Because in crypto, one emotional decision can make you FOMO, and your capital can be depleted, not because of the market, but because of yourself. Part 1. Why risk must be managed. Host. We start from the mindset first. Many beginner traders think, Quan first later deal with risk later. That's a big mistake, because in the real world, even professional traders can be wrong analysis. What makes them survive and thrive is because they know how much risk they are ready to bear and how much reward they are targeting. Remember, our main goal is not to win big once in a while, but to survive long term. And that can only happen if you know your limits. Part 2. Stop loss, the mandatory emergency button. One of the key tools in risk management is stop loss. Imagine you short Ethereum at $3,000, only to see it go up on positive news. If you don't set a stop loss, the price can continue to rise to 3,400 or more, and your losses will be even greater. But if you set your stop loss at 3,100, as soon as the price goes there, your position is automatically closed, and you only lose $100. A small loss, but you can still continue trading. Stop loss is like an emergency brake, not for cowards, but for people who want to survive on the long road. Part 3. Position sizing, Don't put all your eggs in one basket. Next is position sizing, alias how much capital you use in each position. Common beginner trader mistake? Put all your capital in one position because you're so sure about the direction of the market, even though the market doesn't care about your beliefs. Ideally, you should only use 1 to 5% of your capital per position. For example, if you have $1,000, then per trade, you should only use $10 to $50. If one position loses, you still have many bullets to get up. It's not about how big the profit is, but how consistently you can survive. Part 4. Risk to reward ratio. Don't enter a trade that's not worth it. Before you enter a position, try asking yourself, if I lose, how much do I lose? If I gain, how much do I gain? Ideally, your risk and reward should be at least 1 to 2. This means, if you're prepared to lose $100, make sure the potential profit is at least $200. If it's smaller than that, don't take it. Not worth it. Not all opportunities you should pursue. Remember, successful traders are not those who enter a lot, but those who know when not to enter. Part 5. Don't let leverage destroy you. Now let's talk about leverage. Leverage is like a sharp sword. It can help you make big profits, but it can also stab you in the back. Let's say you have $100. With 10 times leverage, you control a position worth $1,000. Up 2%. Not bad profit. But if it goes down just 10%, your account can be liquidated, and your capital is forfeited. Advice for those of you who have no experience. Start from small leverage, or even don't use it first. Focus on learning strategies and market psychology. Okay, in the crypto world, strategy is important. But without risk management, even the best strategy can backfire. Put stop loss. Calculate positions wisely. Don't be overconfident. And don't be greedy. In the next chapter, we will discuss examples of real scenarios, long and short simulations in real market conditions, so that you understand how to apply all this directly. Stay calm, stay smart, and stay a disciplined trader. Chapter 4. Two-way strategy simulation in the real world. Okay, now we enter the most awaited part, namely the two-way strategy simulation, so that you don't just understand in theory, but also can imagine how the practice is in the real market. We will discuss 2 scenarios, one for long positions and one for short. Let's get started right away. Part 1. Long simulation. The market is bullish and you're in the gas. For example, early May 2025, you are monitoring Ethereum. ETH price at that time was around $2,700. A few days earlier, ETH had broken out of important resistance at 2,500. Volume increased. Market sentiment is also starting to be bullish because the Purge network upgrade successfully ran. You see an opportunity. You open a long position at 2,700. Your target is 3,200. Your stop loss is 2,580. This means you are ready to lose $120 per ETH. But your target profit is $500. Risk-reward ratio? About 1 to 4. Very good. 3 days later, ETH rises sharply. Price breaks 3,250. You close your position at 3,200. The result? Profit of $500 per ETH, while staying calm because your risk has been locked in from the beginning. Part 2. Short simulation. The market starts weak. You take a position in the opposite direction. Now we're back. We'll take a short simulation. Early April 2025. Bitcoin just failed to break 75K. Sentiment starts to weaken. RSI on the daily chart shows overbought. And news comes that some countries want to tighten crypto regulations. You feel it's a good time to go short. You open a short position at 72K. Your target is 66K. Your stop loss is 73,500. Risk reward is still okay. Target profit $6,000. Risk loss 1,500. Within 2 days, BTC drops dramatically to 66,200. You immediately close the position. The result? Almost 6K profit per 1 BTC. And you don't need to panic because everything is already measured. Part 3. Things you should pay attention to when simulating yourself. Now, from these 2 examples, there are some important lessons. 1. Always plan your position. Don't enter just because it seems to be going up, or it seems too expensive. 2. Determine your entry, target, and stop loss before you open a position. It keeps you in control and not easily swayed by emotions. 3. Always measure the risk-reward ratio. If it's not balanced, better skip, because not all signals are worth taking. And finally, test your strategy first on a demo account. Don't use real money right away, especially if you are just learning. With practice and simulation, you can understand how this two-way strategy works. And over time, you will also be more sensitive to market patterns, more prepared to make decisions, and of course, more confident to execute. In the next chapter, we will discuss the most common trap that makes many traders give up, namely, emotions. Trading is not just a matter of skill, but also a matter of mentality. Chapter 5. Traders' biggest enemies: emotions, FOMO, and greed. In the previous chapter, we discussed two-way strategy simulation. And now we get into one of the most crucial discussions, but most often ignored. Not about charts, not about indicators, but about emotions. Yup, because the biggest enemy of traders is not the market, but your own thoughts and feelings. Part 1. FOMO, fear of missing the train. You must have experienced this. Again, scrolling Twitter, seeing a new coin that is said to be 100x, then see the price increase 30% in 1 hour. Immediately thought, wow, maybe this is a golden opportunity. If I don't enter now, I'll regret it. Finally, buy at the top. And 2 hours later, the price collapsed. That's FOMO, fear of missing out. FOMO makes you enter a position without analysis, without planning. Just follow the euphoria. And usually, the result is stuck. How to fight FOMO? Simple. You must have rules, have a system, and believe in your own strategy, not the whispers of netizens. Part 2. Greed, wanting more even though it's enough. Have you ever gotten profit but not satisfied? For example, you have made a profit of 30%, but because you feel, I can definitely make 50%, you hold your position. The next day, the price corrects. Your profit is only 5%, or even minus. That's called greed. Greed makes you unable to get out at the right time, makes you want all the profits, but in the end you end up losing. The solution? Set a target before entering. If the target has been hit, take partial profit, or set a trailing stop. Don't want to win perfectly, because you can never control the market. Part 3. Panic, forgetting to plan when pressure comes. When the market drops quickly, or when prices suddenly rise like crazy, panic is very easy to come. People who had a set strategy can change their mind just because of a red candle on the chart. Who initially wanted to hold, suddenly cut loss. Who initially wanted to wait for confirmation, instead jumped in without thinking. Panic is a sign that you don't trust your own system. That's why it's really important. Have a trading plan and learn discipline. If you have set stop losses and targets, let the system run. Don't tinker too much when the market is moving wildly. Part 4. How to train mental trading. Mentality cannot be formed from theory, must be through practice and experience. Some tips to build a strong mentality. Use a demo account for real-time simulation. Limit the number of active positions to focus. Write a trading journal. Record the reason for entering a position, emotions during entry, the final result. From there, you can see your own mindset. And slowly you can recognize your emotional weaknesses. Remember, successful traders are not those who are never wrong, but those who can control their response when wrong. So from now on, don't just train your technical skills, but also train self-control. FOMO, greed, and panic. They are enemies that you can conquer, as long as you are aware, and have a system that you adhere to. In the next chapter, we will enter the last practical stage. That is how to develop daily and weekly strategies, so that you have a clear routine, and not just trading. Chapter 6. Daily and weekly strategies for consistent profits. Okay, we've learned a lot, starting from two-way strategies, read market signals, risk management, until how to control emotions. Now we get to the last part. That is routine. Yes, in the trading world, consistency is not just about skill. It's also about habit. If you don't have a clear routine, you will be easily distracted, easily take an arbitrary position, and eventually become a victim of the market, not a perpetrator. Part 1. The efficient trader's daily routine. Every morning, take 15 to 30 minutes for market scan. What do you check? 1. Global market trends. Look at indices like NASDAQ, DXY, and interest rate data. 2. BTC and ETH prices, because these two are often indicators of overall sentiment. 3. Big news in the last 24 hours. Updates from the Fed, SEC, or big projects like Ethereum, Solana, or popular Layer 2. 4. Check the chart of your favorite coin. See if there are interesting patterns. Breakout, retest, reversal, or sideway. After that, take note of the coins that are on the watch list today. Determine the entry area, stop loss, and target. You can use a simple note or trading journal application. The important thing is to have a structure. Part 2. Weekly strategy, evaluation, and reset. On the weekend, do not rush to find entry signals. Use the time to evaluate. Ask yourself, how many positions did I take this week? What percentage was profitable? How much did I lose? Was I disciplined with my plan? What emotions came up during this week? After that, reset your mindset for the following week. See the progress of major projects. See if there are any upcoming macro events. For example, the Fed meeting, inflation data release, or anything else that can move the market. Remember, 1 week in crypto feels like 1 month in the regular world. So updates are mandatory. Part 3. Tools to help make it less complicated. If you want to be practical, there are many free tools that can help you carry out this routine. Example, TradingView, create charts and technical analysis. CoinMarketCal, for viewing crypto events and news. CoinGlass, or look into Bitcoin, for on-chain and funding rate analysis. Notion, Evernote, or Google Docs, for writing journals and watch lists. The main key is not to use the coolest tools, but use them consistently. Don't let tools become a distraction. Make everything feel complicated. Keep it simple and repeatable. Part 4. Discipline is superpower. Even if you use the coolest strategy, most updated, most complex, if you are not disciplined, you will still lose. But if you use a simple strategy, and you live with discipline every day, it can be a superpower. The key to all successful traders is not that they are always right, but that they have good habits and consistently apply them. That's it. The end of the Crypto Profit Master series. You now have all the foundations: strategy, analysis, risk management, emotional control, and daily routine. Now all you have to do is practice. Start small, be consistent, and keep learning. Don't rush to be a sultan, but rush to be disciplined. And remember, the market can change at any time, but your mentality, knowledge, and system, that's what makes you stay profitable in the long run. Okay, before we end, don't forget our golden rules. 5 important rules of Mr. So Crypto. First, don't use hot money. Use extra or idle money. Do not use money for daily needs or money that will be used in the near future. Second, don't over-leverage. Risk what you can afford to lose if you trade derivatives, futures. Always use a stop loss because the crypto market is very volatile. Third, 70 Bitcoin 30 altcoin. Always allocate more in Bitcoin because Bitcoin is the parent of crypto. By allocating more in Bitcoin, your portfolio will be safer when the market does not meet expectations. Fourth, always stay cash. Always stay in cash 10 to 20 to buy when the market discounts or drops significantly. Then you can sell when the price has risen so that you still have cash for the next discount. Fifth, think long-term. Investing is not about 1 or 2 days to get rich. So think long-term and minimize the risks that might make your money disappear. Everything takes time. Remember, Warren Buffett didn't build his fortune overnight. If you find this video useful, help us to continue to make videos like this by clicking subscribe and share with your family and friends. Don't forget to let us know in the comments column if there is anything you have questions about, because your comments mean a lot to build this channel. See you soon, and don't forget, HODL knowledge and mindset first, then HODL assets.